Hello, everyone. Welcome to the Q3 2025 quarterly market update. As always, trying to keep this to under 20 minutes for you. I am Brendan Noonan, and this is David Moe.
It's nice to meet you all. Brendan's new assistant. During our transition 2 years ago, I was helping him move over his in your account over to us. And so I'm glad to be assisting him again and working with you all. And it's nice to meet you.
Thanks,
Thank you.
David. All right, that's housekeeping out of the way. Now we'll get into the presentation here. Let me just share my screen. Family update here. Hard to believe, but Cameron just turned 3. So she is growing like a weed. And if you notice, she is always in a dress with sleeves because she, of course, is a princess. So that's the most exciting news, most recent news. Ella turning 11 tomorrow. And this is our trip up in Coeur d'Alene. This is the family celebration of Cameron's birthday here. And then Ava down here, who's 14, crushing it in volleyball and hoping to try out for the San Ramon High School volleyball team coming up this year. All right, here we go. Theme for this quarterly update is the Back to the Future theme. Hard to believe, but 40th anniversary of the original Back to the Future movie with Michael Fox. Couple things we're going to cover here. Tariffs, we're going to talk a little bit about tariffs, a little bit about an economic update as well. We'll talk about equities, fixed income, and then, of course, I cannot skip an opportunity to talk about asset allocation and long-term growth. So without further ado, we'll get into the tariffs. So back in the 1970s, Back to the Future theme here, right? We're going to go all the way back to the 1970s, take that DeLorean back to the 1970s and talk about a term that you may or may not remember from the 1970s called stagflation. So some may be concerned around stagflation and that it's rearing its head potentially again, as it did in the 1970s. And we are here to say that this might be a little bit different. So some of the characteristics that illustrate or characterize stagflation is high inflation with little economic growth and high unemployment. Okay. And so if we look in the left column here, we had inflation up at 13-ish%. We had negative GDP or negative economic growth at minus 3%, and high unemployment to the tune of around 7% back in 1975 to 1980. Fast forward to today in 2020 to 2022, inflation now at about 4-ish%. Something like that, with a target of around 2, hence why interest rates are still quite high today. Economic growth, still positive, so about 2.4 to 2.6%, which is great. And then unemployment still at a pretty decent low, so just over 4% unemployment. So although it feels a little bit weird, right? And some of the tariff noise is creating some additional drama in the marketplace. Very different than the 1970s for sure. One other item here I want to quickly briefly talk about is oil, right? And so when we talk about oil, back, in the 1970s, you may or may not recall, we had the license plate deal, right? Where if you were even or odd in the last number of your license plate dictated what day in which you could go out and buy gas. Well, today it's a little bit different. Our domestic production of oil actually fulfills 100% of our consumption. And so what does that mean? That means that we are less dependent on international production of oil. So when we have wars and drama and conflict in the areas that produce oil for us, our price per barrel is less susceptible to fluctuation in that price, simply because we are less dependent on those other countries to produce for us because, again, we can fulfill our own obligations here. If we look at inflation, right, back in 1980, the inflation adjusted price per barrel that would dictate that barrel of oil would cost $150 today. Well, the target for 2025 is around $65 and potentially trending lower than that given our production domestically here. Getting back in the DeLorean, fast forwarding to 1990. In the 1990s, we're going to talk a little bit about some economic policy and our good friend, Mr. Alan Greenspan. 1990 was the second largest expansion in history. So briefly, an expansion is when our economy is continuing to grow, and a contraction is when our economy is slowing. Okay, and so second largest expansion in history. And that was brought on by a little bit of help from an adjustment to interest rates. So our buddy Alan Greenspan reduced rates a couple times here throughout the 90s to extend the expansion. Okay, and we are anticipating that the current expansion that we are in, which you can see here on this chart, is going to be a little bit around the same, and where we're going to potentially reduce interest rates. So the Federal Reserve is going to reduce interest rates with our buddy Jerome Powell, and potentially continue this expansion here going forward. So for this reason and some others that we'll cover as well, not anticipating a recession just yet for 2025 or 2026. Back in the DeLorean, moving to the 2000s now, in the dot-com bubble. If you are familiar with the dot-com bubble, that was when everybody and anybody had a company with a .com on the end of it. They were printing money. Okay. If we look at the similarities and or differences between the dot-com bubble and what some think we might be in a tech bubble today, we overlaid on this left side here, the light blue is the dot-com bubble chart from 1995 to the early 2000s. And the dark blue line here is the tech rally as well. And as you can see, fairly similar thus far year to date. We're falling right in here somewhere. But I would argue that some of the fundamentals are quite different than they were back in the early 2000s. And we can look at some of those stats here. Dot-com bubble, there was 39% of homes that had a computer. Today, 97% of homes have a computer. In the dot-com bubble, there was 3.6% actually had access to the internet, and almost 70% have access to the internet today. PE ratios today, they're a little bit higher than the dot-com bubble, but I would argue that because margins or profitability of these tech companies are almost double what the profitability was back in the early 2000s. So it might actually be okay that our price to earnings ratio, this PE ratio, is slightly high. So nothing to fret about yet. In that vein, within your portfolios, what does that mean for us, Brendan? We'll still going to stay fairly tech tilted, right? So not just AI, but general info tech. In addition to AI, still incorporating some healthcare into portfolios, and certainly keeping our tilt to the industrial sector as well. Mostly because we have efficiencies from a tech perspective. We have accelerated earnings in the healthcare world, and then from an industrial perspective, not only the AI data centers, but certainly stockpiling from a defense perspective, right? So we got to replenish some of our defense that we've been helping other countries with. Okay, so back in the DeLorean again, and we're coming up to today, right? So we're back to today, and we're going to talk about fixed income and the impact of fixed income on your portfolios as well. In this chart, a little bit convoluted, but what I want to bring your attention to is the blue diamond that is above all of those lateral blue lines. So that blue diamond is the demand for our bonds that we issue here in the United States. Okay, The blue bar, the dark blue bar, is the average, the 5-year historical average of demand for our debt. And so, although some people might be concerned about us issuing new debt and who is actually going to be out there buying that debt, the demand for that debt today is actually higher pretty much across the board than the 5-year average. And that's domestically here on the left-hand side. And then you can even look in internationally here, the demand for our debt is actually pretty high as compared to the average across the board. One important note here, even though we talk about fixed income, we still want to stay on the short end of the yield curve. Okay, well, Brendan, what does that mean to me? Well, that means that we can go out and buy bonds that mature 2 years, 5 years, 10 years, 30 years. Okay, so that means that if we went out and bought a bond today that matures in 10 years, we would hold that bond for 10 whole years, receiving an interest every single year, and then after that 10 years, then the US redeems that bond from us and gets our money back. Okay. Well, if we look at the differences between the yield, the dark blue line here, of the 2-year, the 5-year, and the 10-year, we're not getting paid a whole bunch more to have the US government have our money for twice the period of time. Okay. And so if we can go out and earn 4% in a 2-year bond or 4.2% in a 5-year bond, okay, we're going to stay on the shorter end of these curves because the yield is fairly similar and we can create liquidity by the US redeeming those bonds on a more frequent basis. Okay, so in addition to that, what bonds are we actually buying out here? Well, certainly holding municipals. Okay, municipals is that double tax-free if you're blessed to live in California, double tax-free state and fed. Okay, if you live in a tax-free state like Florida, for some of you, we would own federal bonds. Okay, so those federal bonds are federally tax-free as well. US Treasuries, those are also state tax-free, and certainly some investment-grade bonds in your IRAs as well. Staying away or minimal exposure from these high-yield bonds currently because the spread, the amount of yield that we're getting as compared to some of the other bonds are just not as attractive at the moment. Last but not least, asset allocation. Like I said, I can't give up an opportunity to talk about asset allocation. Doc Brown, staying with the theme here, right? For the Back to the Future theme, your future hasn't been written yet. No one has. Your future is what you make it. So make it a good one. Thanks, Doc Brown. Well, what is this really saying? Is, yeah, we can go back and we can learn from the past, right? I think it's fool me once. I don't know what the phrase is, but fool me twice, right? We don't. That's on me, right? Fool me twice. So what we're saying here is let's learn from the past. Yes, this time feels different, right? But instead of comparing this time to the last time or whatever it might be, let's just learn from the past around like market timing as an example, okay? And so the biggest challenge that we talk about when we talk about market timing, fairly easy to make a decision on when we want to get out of the market, okay? The harder part about pulling out of the market is figuring out when we want to get back in, all right? Now, if we look in a historical setting, and we go back in the S&P 500 for a 20-year period of time, rate of return over the S&P 500 on an annualized basis is about 8%, okay? Now, if we missed the best 10 days over the last 20 years, okay, I'm going to say that again, if we missed the best 10 days over the last 20 years, our average annual return is about half. Okay, so we'll go from 8% to about 4% because we missed 10 days in the last 20 years. That's a pretty big deal, okay? Also, another fact is those best 10 days are right on the backside of some of the worst days, right? And so if we feel, right, we get emotional, we make decisions with our heart and not our brain about maybe getting out of the market because we had a bad day or whatever it might be, we're opening up ourselves to some challenges. And so I would encourage you to see past the short-term noise and continue to stay long-term growth focused. It also pays to stay long-term growth focused. If this chart here, the blue is the bull markets, the red are the bear markets. Bull is good, bear is bad. The bull markets not only lasted for a significantly longer period of time, 5 times longer on average. The actual average magnitude of those bull markets was exponentially higher than the magnitude of the bear markets. And so if we continue to stay long-term growth focused, investing in companies that are out there to make some money, over the long run, that should be a good thing for you. Last but not least, lessons learned from the past. Brendan, we're at an all-time market high yet again. Is it time for us to do something different? Take some chips off the table, whatever it might be. Well, one factor here, right, is this blue bar here is talking about the average return over the next 12 months after the S&P 500 reaches an all-time high. Okay. Now, the historical performance of the S&P 500 is about 7.5 to 8%, if you go all the way back to the early 1930s. Okay. 10.4% is the average 12-month return after achieving an S&P 500 all-time high. Okay. So staying invested, letting the winners continue to win, and looking at that long-term growth is going to be crucial for you. Like I said, trying to keep it under 20 minutes for you. Appreciate you joining us for Q3 2025 quarterly market update. Should you have any questions, you know how to get a hold of us. Have an incredible rest of your day.